Okay, so imagine this. You're at the helm of a really successful global company, a leader in its field. And then this massive infrastructure project lands on your desk. But here's the catch. It's in a fast developing country, one experiencing like huge inflation. How do you, as a responsible leader, weigh that seemingly golden opportunity against what could be some pretty significant, maybe hidden risks?
That's the classic international business dilemma, isn't it? It's exactly where the, let's say, theoretical benefits crash into the very, very real world challenges.
Absolutely. And today, we're taking a deep dive into precisely that kind of scenario. We got a really fascinating case study before us, Penco. They're a well-established European construction giant.
Right.
And they're considering this pretty ambitious tramline project in the West African nation of Zanadia.
Yeah, and we'll be, sifting through the financial projections, trying to get a handle on the local economy details, and uncovering some hopefully insightful clues into the potential risks involved here. Our main goal really is to understand the financial viability of this deal, specifically for its initial 2-year phase.
Exactly. And then, crucially, we need to unpack the significant challenges and maybe the more nuanced issues Penco would face if they do choose to proceed beyond that initial stage. Think of this deep dive as, your shortcut to understanding that really complex dance between opportunity and risk, but on the global stage.
We're going to try and break down the numbers without overwhelming you, hopefully highlight some perhaps surprising real-world dynamics, and leave you with some crucial insights into making these kinds of high-stakes international investment decisions.
Okay, so to really get a grip on this dilemma, we first need to get to know the key players and the battlefield, so to speak. First up, Penco. Now, this is a very successful European company. They're a market leader in train tracks, tram lines. So they got a strong reputation, completing complex projects on schedule, and this seems important, ethically.
That ethical standing is, it's a significant asset, especially when you look at their financial bedrock. Penco is based in a dollar currency country, pretty stable, 5% annual inflation, 0.25% income tax rate. It's a big globally listed company, market cap around $655 million, $145 million in bonds. So quite solid.
Solid is the word. And their internal cost to capital.
It's stable, 10% nominal, but importantly, they use a higher 12% risk-adjusted nominal rate, specifically for projects in developing markets like Zanadia.
Which sounds prudent. So a very stable player, cautious approach to risk in new territories. And now let's look at the other side of this equation, Zanadia. Small but rapidly growing West African nation. Local currency is the dinar. And the economic numbers here are, they jump out at you.
They really do. An economy that's grown over 15% annually for the last 5 years, that's huge.
Huge growth.
But there's always a but, isn't there? It comes with a significant caveat. High inflation, currently running at 30% per year. That's substantial.
30%. Wow. Okay, and the political context.
Well, it's a democratically elected government. The prime minister is, let's say, publicly taking credit for this prosperity. And he seems to hold a strong belief that robust trade links with European multinationals, companies like Penco, will generate substantial returns with minimal risk. Especially, he thinks, on government contracts.
Interesting perspective. So what's the actual project that brings these two very different entities together? What's the plan?
The project itself is, on paper, quite appealing. An environmentally friendly electric tramline network. The vision is for Zanadia's capital city, Ennis, and the ultimate goal is 20 years out.
20 years, okay.
But our focus, and Penco's immediate focus, is on the initial contract. That's laying a 23-kilometer tram line connecting Ennis to the national airport. And this is just a 2-year phase.
Well, only 2 years initially.
Exactly. And any extension, building out the rest of the city network, hinges entirely on the satisfactory completion of this first part.
Okay, that immediately raises some flags, doesn't it? The questions about long-term stability, return on investment, especially for a company like Penco that plans long-term.
Absolutely. How do you even begin to sort of quantify that stability or the lack of it?
Which leads us right into the critical financial assessment.
Yeah.
The core task, as I see it, is assessing that initial 2-year period, discounting the nominal dollar cash flows at Penco's appropriate cost of capital.
Right. And just to be clear on nominal, we use that because these are the actual dinar amounts Penco expects to physically receive or spend at those future dates in Zanadia. They already reflect Zanadia's high inflation.
Got it.
We handle the conversion to dollars and applying PENCO's cost of capital separately. That gives us the true picture for them. And the source material gives us some pretty clear dinar cash flows to start with.
Okay, let's lay them out. Revenue.
Okay.
Looks like a fixed price. Dinar 5,000 million for the initial contract, but it's not paid up front, which is key. It's staggered. 10% at 6 months, 20% at 12 months, 40% at 18 months, and the final 30% right at the end, 24 months.
Okay. Typical milestone payments and costs.
Costs. There's an initial machinery purchase, dinar 1,000 million. That happens right at the start, time zero.
Right.
Big outlay.
Then locally incurred labor costs estimated at 30% of the revenue, so linked to the income stream.
Okay, and there's a crucial detail here too, right, about materials.
Yes, exactly. The Zanadian government has already bought the materials for this initial phase. PENCO is only responsible for basically laying the track and testing it.
Interesting. That takes one variable off PENCO's plate, but maybe adds others we'll discuss later, like quality control.
Good point. And taxation in Zanadia.
The government taxes company profits at 40%, pretty high rate. And it's payable in the same year the profits are earned. Also, no provision for tax allowable depreciation or TAD.
Ouch.
Yeah.
So 40% straight off the top, no depreciation shield. Okay. The dinar cash flows seem relatively straightforward then. They do, but this next step, this is where the real complexity and maybe the potential for big mistakes comes in. Converting those dinars to dollars.
Ah, the exchange rate challenge.
Precisely. The current spot rate is given as dinar $150 and $175. Now, you have to think about which rate applies when.
Okay, walk us through that. Bid versus offer.
Right. PENCO needs to buy dinars initially for that dinar 1,000 million machinery purchase. So they'll be selling dollars. That means they get the less favorable rate, the dinar 151 rate, the bank's bid price for dollars.
Okay, so they get fewer dinars for their dollars on that initial purchase.
Exactly. But then for all the subsequent dinar revenue they receive,
The 5,000 million.
right, that income stream, they'll be selling those dinars and buying dollars to eventually remit home. That would typically involve the other side of the, quote, the dinar 155 offer rate, or whatever the prevailing market rate is at those future points in time.
And those future rates aren't just a wild guess, are they? There's a theory for projecting them.
Correct. This is where purchasing power parity theory, or PPPT, comes into play. It's a standard tool, though not perfect.
How does it work, basically?
Well, the idea is to project future spot rates based on the difference in inflation between the two countries. You've got Zanadia at 30% inflation, PENCO's home country at 5%. That's a huge differential, 25%.
Okay.
PPPT suggests the exchange rate should adjust over time to reflect that difference, so that, theoretically, a basket of goods costs the same in both countries when measured in a common currency. It's about maintaining purchasing power.
So higher inflation in Zanadia means the dinar should weaken against the dollar over time.
Exactly. The dinar rate should increase. And the calculation needs care. You have to apply it correctly for half-year periods as well as full years based on those inflation rates.
And the source suggests, using PPTT, the rate at 12 months is projected around 217 dinar, and by 24 months, it's up to 269 dinar. Is that right?
That's what the calculations based on PPPT would yield, yes. Significant depreciation of the dinar.
And converting correctly is vital.
Oh, absolutely. It's a critical point where missteps can really skew the financial picture. You have to divide the dinar cash flows by the projected dinar spot rate for that specific time period. That gives you your dollar equivalents. Get that wrong, and your whole analysis is off.
Okay, so once we've painstakingly converted all those dinar flows into projected dollar flows, what's next?
Then we apply PENCO's discount rate. Remember, they use that specific 12% nominal risk-adjusted rate for developing markets.
Right, the higher rate acknowledging the extra risk compared to their standard 10%.
Exactly. So the mechanics are then fairly standard present value calculations. You apply the relevant 12% discount factors for each period, 6 months, 12 months, 18 months, 24 months, to those projected dollar cash flows. Sum them up.
And the moment of truth. What's the outcome for this initial 2-year phase? Does it look good on paper?
Well, after running all those numbers, the revenues, costs, taxes, the exchange rate projections, the discounting the calculated net present value, the NPV, comes out positive.
Positive, okay. By how much?
Positive $0.86 million. So nearly $1 million in today's terms.
Right, so what does that $0.86 million actually mean?
It means that, based purely on these financial projections and all the assumptions we've made, the project appears financially viable. It's expected to generate more value than it costs, considering the time value of money and the perceived risk baked into that 12% discount rate for that initial 2-year phase.
Okay, based on assumptions is the key phrase there, isn't it? We need to be really clear about what those foundational assumptions are for this positive NPV.
Absolutely crucial. First, it assumes that the 12% nominal risk-adjusted cost of capital is, in fact, the correct rate for a project of this nature in Zanadia. Is 12% enough compensation for the risk? Maybe, maybe not.
Okay, what else?
It assumes there's no additional taxation back in PINCO's home country when those dinar cash flows are eventually remitted as dollars. That needs checking.
Right, tax treaties and things like that.
Definitely. A really major one. It assumes inflation rates in both countries will stay constant for the next 2 years. 30% in Zanadia, 5% at home. That's optimistic, maybe, especially the 30%.
Yeah, high inflation can be volatile.
Very. We're also assuming the PPPT formula gives an accurate prediction of future spot rates. PPPT is a long-run theory. It can be quite inaccurate in the short term.
Good point. Any others?
And finally, the model assumes no residual value for that machinery after 2 years. The justification is it'll be used for the larger project, but it's still an assumption in the 2-year evaluation.
Okay. So a positive NPV of $0.86 million, but resting on quite a few significant assumptions.
Precisely. Which brings us to the next stage.
Right, because finance isn't just about spreadsheets. A positive NPV is compelling, sure, but a seemingly viable project can, run headfirst into real-world complexities.
Especially in a context like this.
So what are the big risks? The major issues PenConnect has to consider, particularly given this is just the start of a potential 20-year commitment?
Well, one of the most maybe revealing things in the source material is the track record of other European multinationals in Zanadia. It's described as having varied success.
Varied success. That sounds like diplomatic language for some did okay, some got burned.
Pretty much. And specifically, political interference, particularly from the prime minister, is explicitly blamed for below-par returns.
Okay, that's not just vague rumor then. It's a documented pattern.
It seems to be presented as a known issue, so PenCo can't just ignore that. They need to dig into why. What kind of interference? How did it manifest? What did it cost those other companies?
That's a huge red flag. What form does this interference take? The sources mention rumors, specifically about the prime minister ordering ad hoc requests for payments.
Yes. That's a very delicate phrase, isn't it? Ad hoc requests for payments.
It sounds like potential demands for, extras, bribes maybe.
Sure.
How does a company like PenCo, with an ethical reputation, even get clarity on that?
That's the million-dollar or maybe multi-million-dollar question. It requires incredibly thorough due diligence, maybe talking to those other MNCs if possible, understanding the local political dynamics deeply.
And figuring out how such charges, if they exist, would impact profitability, and maybe even the fundamental decision to proceed at all.
Absolutely. The cost isn't just financial. For an ethically focused company like PenCo, the reputational damage could be far worse.
And adding to that uncertainty, you mentioned the Prime Minister's review for the contract extension.
Yes. He will personally review the work before deciding on extending the contract beyond 2 years. But the criteria for this review, not specified, and described as highly judgmental.
Not specified and highly judgmental. That sounds terrifyingly subjective.
It's essentially giving the government, or specifically the PM, enormous leverage down the line. PenCo could complete the initial phase perfectly to spec, on time, on budget.
And still not get the extension based on some undefined subjective criteria.
Exactly. It creates massive uncertainty for that 20-year vision. How do you invest seriously when the next 18 years depend on a review with no clear rules?
That's a massive strategic risk. Okay. What else? You mentioned supplier quality earlier.
Right. PenCo usually manufactures and lays its tram lines. They control the whole process. Here, the Zanadian government has already bought the materials from a third party.
So PenCo loses control over a key input.
Which immediately raises potential quality and specification issues. What if the materials aren't up to PenCo's standards? What if they cause delays or failures during installation or testing?
PenCo could end up being blamed, impacting their reputation, even if the root cause was the materials they were given.
Precisely. It's a significant operational risk they wouldn't normally face.
And then there's the sheer length of the overall project. 20 years is the goal, but only 2 years are actually contracted.
And those substantial returns promised for the extension phase, they're completely not quantified.
So it's a bit of a leap of faith. Invest for 2 years based on a marginal positive NPV, hoping for undefined substantial returns later, subject to a subjective review.
That sums it up pretty well. It adds significant long-term financial risk and planning uncertainty. How do you commit resources, personnel, capital for a multi-decade project when most of the upside is completely undefined?
Oh, yeah. Beyond those big ones, are there other, maybe broader operational or ethical concerns?
Definitely. There's a whole area of local adaptation. Penco needs to understand and navigate local customs, work practices, cultural nuances. That's standard for international projects, but still crucial.
In the legal and regulatory environment.
Needs thorough assessment. Laws can change quickly in a fast-developing economy like Zenadia. What are the dispute resolution mechanisms like? How stable is the legal framework?
Human capital, too, I suppose. Do you send managers from home or hire locally?
Exactly. Pros and cons to both. Local managers bring local knowledge, networks. Expat managers ensure consistency with Penco's standards and ethic, perhaps. It's a key strategic decision.
And underpinning everything, as we touched on, is reputational risk. Ensuring this project, whatever happens, doesn't damage Penco's hard-earned global business and ethical standing.
It's paramount, especially if things like those ad hoc payments are a real factor.
It's a minefield. And it really highlights that even with that positive NPV, the numbers themselves are built on estimates, which suggests sensitivity analysis.
Oh, absolutely essential. Penco must conduct sensitivity analysis. What happens to that plus $0.86 million NPV if the cost of capital should really be 14%, not 12%?
Right. Or what if inflation in Zenadia spikes even higher, making the dinar depreciate faster than PPPT predicts, or slower?
Exactly. Testing the impact of changes in those key variables, discount rate, exchange rate projections, maybe even labor costs or project delays, is critical. It shows how robust or fragile that positive NPV really is.
If we connect this to the bigger picture, it just demonstrates how uncertain financial projections can be in these kinds of environments.
It really does. A positive NPV is, a necessary starting point perhaps, but it's far from sufficient on its own. It's just one piece of a much, much larger and more complex puzzle, especially when you're dealing with the political and operational realities of an emerging market with, shall we say, a history.
It really underscores the importance of asking what if over and over again before making such a huge commitment.
Couldn't agree more.
So we've journeyed through the financial calculations, the apparent viability, but also the really intricate web of risks facing Penco with this potential tramline project in Zenadia.
Yeah, we saw that positive financial assessment for the initial 2 years, but against that, a landscape just full of potential political, operational, and importantly, reputational challenges.
Yeah.
Challenges that go way beyond the balance sheet.
Right. And this deep dive hopefully wasn't just about crunching the numbers themselves. It was about trying to understand the nuances of these big, high-stakes international business decisions.
Where a project that looks okay on paper, maybe even good, can be absolutely fraught with hidden complexities and risks that aren't easily quantified.
It's about being really well informed, isn't it? Not just on the NPV result, but the why behind it, and crucially, the what ifs.
Absolutely. The context is everything.
So here's a final provocative thought for you listening. Given everything we've discussed, the positive financial projection for the initial 2 years, but weighed against all those significant unquantified risks, the shadow of those ad hoc payments, the known history of political interference in Zenadia, what would you do if you were the CEO of Penco? How do you actually make that call? How do you weigh potential but undefined substantial future returns against such considerable, often qualitative risks right now in an emerging market like this?
It's a tough one. And as we've seen, the decision clearly isn't just about the dollar signs. There's so much more to consider.